Welcome back to Real Estate 101. Today we're going to continue our discussion on mortgage financing and talk a little bit about some new mortgage rules. And I'm pleased to be joined once again by Tracey Brock of Dominion Lending Centers. Tracey, welcome back to the show.
Thank you, Joe.
All right, Tracey, you want to give me a little bit of a summary on some of the changes the federal government has come out with over the last few months?
Sure. I would say that the main three changes would be that they've implemented what they call a stress test. So meaning that the qualifying rate for all mortgages has been installed so that in the past, if you had a mortgage of less than 5 years or you had a variable rate mortgage, you still had to use that qualifying rate, Bank of Canada qualifying rate. But now they've also done that so that if you're taking a 5-year term, you have to do that as well. The second would be that they have restricted low ratio insured mortgages. So meaning that not all institutions, but a lot of institutions still insure their mortgages through CMHC and Genworth, even if there's more than 20% down payment. So they've made restrictions to that, and which has affected a lot of the lenders' business plans in sense. And then finally, CRA has indicated that going forward, if you sell your primary residence, you have to report that. You don't have to pay the capital gains tax on it, but you do still have to report it.
Okay. All right. So why don't you explain a little bit about the stress test on a mortgage?
Okay. So basically what they're trying to, in the government's infinite wisdom, right. Because I mean, this is only hearsay, but I was told that there was no industry consultation before these changes were made.
Really?
Yeah, so it was kind of interesting. Dominion Lending Centers is the largest mortgage brokerage across Canada, and I know that nobody from Dominion Lending Centers was consulted on how these changes may affect the overall marketplace for home buyers.
Right.
But anyways, so a stress test is that should the rates start to increase in the next 5 years, the people who are purchasing these homes can still afford them. So where their rate might be 2.59 or 2.69 to qualify for a 5-year fixed mortgage, they're now asking them to qualify based on 4.64 or the Bank of Canada rate, which fluctuates. Right now it's 4.64. So the stress test is really to predict that in 5 years they can still afford that home if rates were to go up to 4.64. But in all honesty, I think the Bank of Canada rate is a little bit too high because in the last, since 6 years, rates have never been above 4%. So to imply that rates are going to go that high in 5 years, especially after the announcement that I heard last week about the Bank of Canada considering lowering the rate again because the dollar is so weak, 4.64 seems quite high.
All right. So how does this stress test affect somebody or a home buyer who's got less than 20% down payment?
Well, it's going to affect their buying power. They're not going to be able to afford the home that they may have wanted or, projected that they were going to get.
Right.
Because the amount of mortgage is going to be qualifying on a rate that's almost 2% more than the actual rate they're getting. So what's going to happen is that the buyers are going to have to lower their expectations because I don't foresee that the market's going to lower their prices.
Okay, so what about for those with more than 20% down payment?
Well, to be honest with you, it really depends from lender to lender. But now that these monoline lenders, because it's typically the monoline lenders, the Street Capitals, the First Nationals of the world that insure their mortgages with more than 20% down payment, they have basically changed a lot of their guidelines. Some are doing it, some are not doing it. And what's happening is these home buyers are now being forced, in some circumstances, to pay higher rates. So a rate for an insured mortgage and a rate for a conventionally insured mortgage are two different rates. And then what's happening is because of this, it seems that the banks are increasing all their rates across the board because they can now. Right. So if the monoline lenders are raising their rates to 2.79 and 2.89 on a conventional mortgage, the banks are just like, okay, everything's 2.79, 2.89, insured or otherwise.
Right. Okay. So what about homeowners, current homeowners? Does it affect them? Can they still refinance?
Yeah, they can still refinance. I mean, the rules still apply as far as you can only refinance up to 80% of the value of your home. And again, depending on the lender, it depends on whether or not they can qualify based on a 25-year amortization or a 30-year amortization. And then rates again, depending on the letter, fluctuate.
All right. So you've mentioned a few times these different financial institutions and how it may depend on it. Mm-hmm. What exactly are you referring to?
Well, I alluded to that a little bit in saying that depending on the different lenders, some aren't doing rental properties anymore. Some lenders are compensating their insurance by still insuring their mortgages, but on a conventional level, you have to go back to that maximum 25-year amortization and qualifying rate of 4.64. Some lenders are just increasing their rates to compensate for the difference of not being able to insure their mortgages through Genworth or CMHC. So it just, every lender has a different policy and a different way to adapting to these new rules to maintain their profit margins and maintain their investors and the investors that they have. And I'm sure that a lot of them are seeking out new investors with different types of risk tolerances to allow them to still be competitive in the marketplace.
Right. A lot of this sounds like it's insulation for the government and for the lenders.
Yeah. Yeah. What it really, in my opinion, what it's really doing is reducing competition.
Right.
So it's just making it much easier for the larger banks to stay ahead of the game kind of idea. And the larger banks aren't regulated the same way that monoline lenders are. So, it's not necessarily fair competition at the moment.
All right, so let's talk about ratio mortgages here a little bit. What is considered a low ratio mortgage?
A low ratio mortgage would be anything under 20% down payment. So if you have equity in your home of 80% and you want to refinance, that's a low ratio mortgage. If you want to purchase a home and you have more than 20% to put down, that's considered a low ratio mortgage.
All right. So what are some of the changes with the low ratio mortgages?
So if a lender, such as First National or any of the monoline lenders, want to do conventional mortgages, what they've started to do, for the most part, not all of them, some have, there's, like I said, it just depends on the lender.
Right.
But what they're doing is they're making them qualify as if they were an insured mortgage. So maximum 25-year amortization, maximum are qualifying at the Bank of Canada 4.64 rate, which is what it is currently, right. And the property has to be owner-occupied.
Property has to be owner-occupied?
It has to be owner-occupied, yeah.
And what about down payment?
Down payment, well, in that scenario, down payment would be still, like, if it's down payment on a purchase, it can still be from own resources, gifted, and others. Or if it's equity in your home, again, you can only refinance your home to 80% anyways. So,
right.
Yeah.
Okay, so let's talk about rental properties. Mm-hmm. Can people still invest in rental properties?
People can still invest in rental properties. Same rules apply, 20% down. But again, there has been an increase in the rates for rental properties. So you're not going to get that 2.59 rate that you would get if it was owner occupied. You're going to be getting a rate. Most lenders are about 0.25 basis points, 0.25 basis points above whatever the rate is. Some are only about 15, but most of them are up, rental properties are at 3.09 right now in some institutions.
Right. Okay, so let's touch on, let's say hypothetically, homeowners or home buyers don't fall under these rules. Mm-hmm. But they still want to buy or refinance.
Well, that's where we have a lot of these alternative lenders or Alt-A lenders that will come into play because they self-insure. So there's lots of lenders still out there that, can facilitate a lot of the things that have been changed because they're self-insuring their mortgages, so they don't go through any of the government bodies. But they come at higher rates, and typically there's fees associated with those type of lenders. But you still can do it. You're not out of the loop just because you can't accommodate these new regulations.
Okay, let's go back and talk about the CRA regulations that you talked about.
Yep.
Who do these affect?
These affect anybody who sells your home. If you're in a home and you're selling, the next tax year, you have to report that you've sold that home for the X amount of dollars. And although you're not being charged any capital gains,
because it's a principal residence,
they still want to do that. And what they're trying to do is curb some of these foreign investors that are coming into the marketplace, treating every home as owner occupied and not paying any tax on that when they make the profit on it. So that's what they're trying to do. I think that, in all honesty, it's still going to be something very hard to monitor, but we'll see what happens.
Sounds to me more like a paper trail, right?
Yeah, paper trail. That's it. Well, that's what CRA is all about, though,
exactly.
Right?
All right. So, what's your opinion on? These regulations they're already in the marketplace, have been for a few months.
Yeah.
What are you seeing?
To be honest with you, I'm kind of surprised at what I'm seeing. There's still a lot of activity in the buying and selling. There's a lot of activity in the refinancing. I find that buyers are just accommodating. Some of the first-time home buyers have come out of the market for a little bit, and I don't think that's going to be long-term. I think that what they've done is just, and maybe it's just the timing too, it's just before Christmas, they'll regroup after Christmas. It could be, you know what I mean? It could be other factors involved. But a lot of my first-time home buyers have stopped looking for a little bit. I don't think that's going to be forever. I think, like I said, and it's hard to say if it's the timing of the season or the timing of the rule changes. The lenders have reacted by increasing rates, doing what they can to mitigate their risk tolerance and their risk levels by, all the changes I've previously mentioned. And it is getting a little bit more difficult they're more strict with their paperwork and more strict on what they want to show happening so that they have the paper trail. Because really, I don't know, there's not been a lot of information given from the government. This is just, here's the change, deal with it.
And it came out.
Deal with it, yeah. Here's the change, deal with it. And I think that in some effects, because of the fact there was little consultation done, they're kind of backpedaling a little bit. You'll see that the Ontario government now has increased the land transfer tax rebate from $2,000 to $4,000 as of January 1st. So that definitely helps first-time home buyers, as far as expenses are concerned. Is it going to help them get that extra $100,000 in a purchase price that they were looking for? No, but you know what? It's incentive to keep the market going still, right? And I think that the government's never going to admit defeat, but they may start modifying things such as the lending rate. Like, it doesn't have to be 4.64, right? I find it really hard to believe that
it's going to go
in 5 years we're going to be at a 5% interest rate on mortgages. Maybe 3.5, maybe 4. But, it seems unrealistic, 4.64. So it's a very high number. And decreasing that rate from 4.64 to, let's say, 3.64 almost brings the clients back to that buying power that they were at before the rule changes. Almost.
Right. Okay. So for home buyers that are interested in buying with these current rules, what should they be doing?
I think they need to make sure they have a pre-approval in place. They need to make sure that their expectations are in check. I find that a lot of millennials, not to stereotype, but, they've lived in grand homes with their parents and they want the same thing that their parents have. And I think they have to realize that a starter home is just that.
Right.
And if it has to be a town home, you can make any home beautiful. It's your home. It doesn't have to have all the bells and whistles the first time around. It's more important to enjoy your life and not be house poor. So, speak to professional mortgage brokers, speak to them and let them know what your goals are, what you can budget on a month. Think about what you can budget a month and then worry about what the cost of your house is going to be. Because if you're telling me your budget's only $2,000, you cannot afford a $500,000 home.
Yep.
If that's what your budget is. So, it's really, you have to keep it in check. I mean, property taxes are rising in all areas. They're getting higher. That becomes part of your monthly expenses. There's lots of costs that first-time home buyers just can't anticipate. They've never been there, never done it. It's just like when you get your first new car, all of a sudden you think, snow tires, what do I need snow tires for? I just bought a car. So, it's the same kind of perspective. Make sure that you're educated, keep informed, speak to professionals that'll be able to help you and guide you.
All right, Tracey, great stuff. For anybody watching and listening who may want to reach you, how can they get in touch?
They can reach me directly on my cell phone at 416-788-6207. They can go on my website at www.traceybrock.ca, or they can go on the YouTube and listen to Real 101.
All right, Tracey, great stuff. Thanks very much for coming on today's show.
You're welcome. Have a great day.
So there you have it. If you're looking for more information on mortgage financing, get in contact with Tracey Brock of Dominion Lending Centers. Don't forget to subscribe to our YouTube channel, like, comment, and share our videos. I'm Joe. Thanks for watching, and we'll see you next time.